welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, March 23rd, 2023, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we see futures having a pretty decent morning, especially on the NASDAQ. Right now, we've got the Dow Jones Industrial Average up about 82 points. That's roughly 0.25%. The S&P 500 is up about 22 points. That's a little bit more than half of 1%. And then the NASDAQ is up 120 points, which is almost 1%, about 0.95%. So let's just call it 1%. We did have the Bank of England this morning hiking rates by 25 basis points. That is right in line with what the Fed did yesterday, also raising 25 basis points, saying that they considered pausing, but at the end of the day, this is not a bank crisis, and so they're remaining vigilant against inflation. They did change their language, though, to basically say that, hey, we're just going to kind of watch things from here. I'm paraphrasing a little bit, but they didn't really signal that there would be more rate hikes, but at the same time, it's going to be data dependent. So we'll see what that translates into as we get further out. My own opinion, I think that translates into we're about done. But and the market reacted initially like that yesterday afternoon and then came back down. But we were fighting some pretty key resistance, especially on the NASDAQ. We'll be talking about that in just a bit. Today's agenda, let me walk you through that. We will start off with the daily market recap, then talking technically, show you the chart of the day, do a little relative strength, look at it just a little bit different, then the earnings spotlight, and we'll wrap up with the three you must see. But first, let's go ahead and start with that daily market recap. So Thursday, it's Thursday today. Yesterday, Wednesday, that was the wrap up of the two-day meeting with the Fed. So the meeting began on Tuesday morning at 2 o'clock yesterday. They made their announcement. As I said, they raised 25 basis points, which was widely expected. So there was no shock there. I think the real shock would have come on a 50-point basis hike or on a stay the same, do nothing, and keep rates unchanged. I think either of those scenarios would have been either not good for the market or very good. And I'm talking about the stock market. Not good for the stock market or very good. And instead, they went with the status quo, what was expected. And as a result, we saw the market initially move higher. It did what it does in the final 2 hours after a Fed meeting. I always tell members, anything goes. I mean, it's going to be the most volatile period that we're going to see for a while. We probably had a week's worth of volatility in 2 hours in terms of the movement. And we'll break that down and show you that in just a minute. But looking at the charts and just final, end of the day where we finished, the Dow Jones Industrial Average finished down 1.6%. That was 530 points. S&P 500 down 1.65%, down 66. NASDAQ down 1.6%. That was down 190. Mid caps down 2.48%, 61 points. And small caps down 2.6%. That was 30 points. As far as looking at the individual major indices go, probably the key I thought was on the NASDAQ 100, which I don't show here. I show the NASDAQ, which was pretty close to resistance. But the NASDAQ 100 has a lot more weighting on some of the big names like Apple, Microsoft, Google, Tesla, and so forth. And so that index actually threatened a breakout. And I will show you the NDX here in just a couple of minutes to highlight that. That was a bearish reversing candle at key price resistance. I mean, we ended up finishing off the right side of a cup, but we did close back down near the low of the day, and we had a breakout intraday. So when I see all of that, my initial reaction is we're probably going to have some weakness probably over the next couple of days. That's what I would, if I had to place odds, I would say that's the higher odds that we would pull back temporarily. But futures are up. So we'll see what happens after the opening bell. After a day like that, it would be great. I'd love to see the market, react strongly all day long and see a lot of buying. But I would approach today, even if I'm being very bullish like I am, I would still approach today somewhat cautious with that false breakout and with key resistance being tested. Looking at the individual sectors, all 11 sectors finished in the red yesterday after many of them were up significantly during the day. Real estate has broken down again. Big move down 3.65% yesterday, closing at 34.83. You can see we had some support at the end of the year around 36, went just below that recently, and then yesterday clearly broke down. You can see all the action over the course of the last 4 weeks or so has been under the 20-day moving average. We've seen that death cross where the 20's gone below the 50. PPO's negative, pointing lower. So momentum is very bearish right now. I think there's a chance real estate goes back down to test that October low, which would be down probably a little bit below 33, maybe 32 and a half, something like that. That certainly comes into play based on yesterday's breakdown. Financials down 2.3%. That was down almost, $0.75, down to 31.22. That came on the heels of a one-day bounce, and then sure enough, the selling kicked right back in. One thing I would say about this particular chart, we can probably pull that up and see it a little bit clearer. Well, I'm going to need candlesticks. Let's do a candlestick chart. But if you look at the recovery that we saw on Tuesday, it was all gap. I don't like seeing a gap up with little or no follow through, followed by another huge red filled candle. So even though the Fed said, hey, there's no bank crisis here, we're fine, the financial system is strong, they can say whatever they want, but right now the stock market, I believe, is looking at this group saying, hey, if you keep raising short-term rates and the long-term rates are coming down, the inversion is just getting worse and worse. And what I can tell you as a former practicing CPA that audited banks, there's nothing worse for banks than for short-term rates to go up and longer-term rates to come down. That squeezes their interest margin and their profits. So you're going to see probably a downturn to some degree in profits of banks. Now, the question is, how strong is that move to the downside going to be, and how much does it impact lending to the community that depends on financing to grow businesses or their business? And so that's the question that remains. Now, employment remains strong. There's still a lot of signs in the economy that say, hey, we're still humming along here pretty well. But obviously, there's one school of thought here that says, well, if the financials and the banks begin to struggle, that's going to have an impact on the rest of the market. And I actually agree with that to some degree. There have been times where banks have underperformed for a period of time and then they snap back and the market's fine. But if it turns into a full blown out or full blown up crisis, then I think we've got some issues with the overall market. Now, again, I don't think it's a crisis. The Fed says, hey, we're strong, but this is one thing that I think could potentially, I'm very bullish on the market. I think we're going higher, even if we do pull back here in the short term. But the one thing that worries me is the state of the banks, because that is the lifeblood to the stock market and to businesses in general. So they can take a hit. They can go down just like any other sector for a period of time. But what you don't want to see is this group underperforming for an extended period of time. And I'm talking about not just a few weeks, but I'm talking about a few months, 3 months, 6 months. Keep an eye on the group relative to the S&P 500. It's going down now. Does it continue? I think that will be one key going forward. I don't think it's going to longer term, but in the short term, no doubt the way it acted yesterday, I'm not sure that the financials, all the weakness is out of this group at this point. All right, let's go back and finish this up. Discretionary down 2.2%, almost 2.25%, down $3. Failed on that breakout yesterday. I guess we came back down and closed right at about the 20-day, actually a little bit below. So after going above both the 50 and the 20, we came right back down yesterday with a bearish engulfing. Actually, I don't know if that was bearish engulfing. Let's do another candle view here. Yes, it was bearish engulfing. I didn't know if we had gapped up, but we did have a slight gap up. So it was bearish engulfing failure at the 20 and the 50. Short term, that's not a great sign. Not until we get back up above both those moving averages. So that's what I would be looking for. But in the short term, if it pulls back, I would probably expect the market to pull back. And I think the NASDAQ potentially could see 2% further to the downside. That would take it back down closer to its 20-day moving average. And when I say the NASDAQ, I'm talking about the NASDAQ 100, which I'll show you in just a second. Energy failed at the 20-day. I said when we got back up over 80, I'm not a big fan of energy. I'm not a big fan of materials. Thought maybe we could fail, be bullish if energy get back up through about $82. But that was not in the cards yesterday. Gapped up, and then we sold back off again, finishing down at 78.68. So essentially what we've done is gone back up, back tested that breakdown of support, and also tested the declining 20-day moving average. So right now, that's pretty bearish setup for energy. Utilities, as I mentioned yesterday, I was a big fan of utilities coming into March, but I really thought yesterday when we got the big reversal, for me, I think utilities are going to struggle from here. Even though we are still in March, I think it's had its March run. Maybe the next day or two, if the market's weak, maybe we see a little relative strength out of utilities, because that's what we typically do with the defensive areas when the market is struggling. And I think there is the possibility of the market struggling here for the next couple of days. But once we get beyond that and we start looking at April earnings, Q1 earnings season kicking in, I believe the stock market's going a lot higher. And we'll see what happens. We see if I'm correct or not. If I'm not, hey, I'll say I wasn't right. But I see the market going quite a bit higher heading into earnings, and I think it's going to continue right in probably through the first half of May. I'll let members probably know later today where I see it going, but it'll be a pretty big move to the upside. All right. Let's move on to the 10-year Treasury yield. So this morning, the 10-year Treasury yield is down right now at about 2 basis points. A little bit more than 2 basis points. We are at 3.477%. We finished yesterday at 350. Watch this level right here. This support area, 337 to 340. It's one thing to have the Fed meeting and all. The bond market kind of predicts what's going on with the longer term rates, okay? And if this breaks down, chances are it's going to put a lot of pressure on the Fed to stop raising short-term rates. So if we get this breakdown below 337 on a closing basis, and that reversal yesterday on the yield below both the moving averages, I think points to that increasing possibility. If we break down here, I think what you're going to see, number one, is growth stocks continue their big move to the upside on a relative basis. Money has been rotating massively into growth stocks, and I think that continues. I think that's going to continue. And one sign of it would be another breakdown in the 10-year Treasury yield. Now, if you believe the opposite, which, hey, that's fine. Maybe I'm wrong. Maybe rates go up. If rates go up, I think that's the best scenario for bears. If rates come back down, I do not see the bears standing a chance. I just don't. Because valuations were crushed when rates were going up in 2022. And as they stabilize, and especially if they break down, we're going to see nothing but folks rotating into growth stocks more and more and more. The breakouts that we saw yesterday, the breakout we saw on Apple, recently on Microsoft, those should not be ignored. They're the highest weighted stocks on the S&P 500 and the NASDAQ 100. So if they're breaking out and starting to move higher, it's going to make it very difficult for the major indices to move lower. That's just mathematics, pure and simple mathematics. The rest of the market's going to have to drop a lot more to make up for two of the heaviest weighted stocks. All right. Let's go ahead and move on to talking technically. So the S&P 500, there's the chart. You can see the false breakout above the 50 and the move back down below the 20. And there's a lot of technicians saying, well, that's not good. We were above both the 20 and the 50, and we closed beneath both. When I see sideways consolidation, for the most part, I'm ignoring moving averages. I mean, how many times really since December have we gone below the moving averages back above? I'd say if anything, we have a slight uptrend in play, higher highs right now, higher lows, but it's mostly sideways consolidation on the S&P 500. And so moving up above the moving averages is nice because when you're above them, you have the chance of an uptrend. Not that you've, cleared any major resistances yet to support it, but if you're above the moving averages, it just makes common sense. You have a better chance to be in an uptrend. Now that we're below, there's a better chance that you're in a downtrend. But we've seen many failures over the past few months. So I'm just looking at this as still an uptrend. I think if we go down and lose 3750 on the S&P 500, we got problems. Or at least we've got to reevaluate. I have to reevaluate. Not that that guarantees we take out October, but it certainly would begin to point to maybe another test of that October low. But we got to lose 3750 first. I don't think it's going to happen. Anyway, that's the level I'm watching to the downside. To the upside, first thing's 4,200, but really the big level is 4,300. That's the August high. So the longer term downtrend, lower lows, lower high, lower low, and so far lower high, the bulls can't argue that we're in an uptrend yet from a longer term perspective. But you couldn't argue when it was at an all-time high at the beginning of 2022. You had to wait for price breakdowns if you're looking at the long-term chart and you're only looking at price action. But there was a lot of under the surface signals back at the beginning of 2022 that said the rally was more likely to fail and that there was increasing chance of a bear market, cyclical bear market. Where we are now is we're at a point where we can't say that the downtrend is ended, but what I can say is that all of my under the surface signals are pointing higher. So breaking out is simply the last stage. That's the last confirmation. And I just don't like waiting until we get the confirmation to go through 4,300 to be long. I mean, even with yesterday's reversal, getting back into the S&P 500 in mid-June is still a win. And for those of you that are new, that was when I called a bottom. We did go down slightly lower in October, but for the most part, we have held that June low. We'll see what happens from here. You can't will a market higher in the short term. You have to be patient. You have to let the bottom form. You have to let the rotation happen. And have we had a couple of what I thought were some pretty big head fakes? Yes. This one was the biggest back in August, but we rolled back over one more low. We had another one beginning of February. But as I pointed out, mid-February to end of March typically is not a great time for the market. And it wasn't again, still isn't. But when you move into April, historically, the market does much, much better through the middle to latter part of May. And that's where I think we're going to see it before April starts, but I believe we're going to start to see a big rally. NDX. So I wanted to show you this one because this is the one that in the short term bothers me. But what I would look for is a handle here. So if you look at this as a cup, and we'll just put that down in here. I mean, pretty good cup, not exactly symmetrical, but pretty close. And then we get rid of that. You'll see now we had a, false breakout, reversing candle. Not great. But what I would look for off of a cup following an uptrend is a handle back to the 20-day. So that's where I get my 2% to the downside. That's probably down. Well, that's down at 12,300. And we're at 12,567. So that's roughly 267 points, which is just a little over 2%. to the downside. So even though futures are up this morning, I think we could still falter over the next couple of days. I wouldn't be shocked. If we had made the breakout yesterday, I think we'd have been off to the races, but we failed on the breakout. So I think that potentially leads us to a 20-day test. And I've told members how to position on any further pullback. Not going to go into it right now. Want to get through a couple of other areas that I want to talk about. But right now I'm seeing a cup. I think it looks pretty good. I think that is a bullish pattern, and a handle sets up the next move beautifully. So let's talk about the chart of the day. Actually, before I'll get into that relative strength in just a minute. Here's the chart of the day. The XLK relative to the S&P 500. Now, as you can see, since 2013, this ratio has been going higher. We had a huge move up in the pandemic, and we kind of struggled a little bit when the inflation kicked in. We had one more move toward the end of the year, and then, of course, that's when a lot of the warning signs kicked in. And during the first half of the year, we saw a pretty steep decline in technology on a relative basis. We had one bounce, went back to one more low, held. Notice we have a triple bottom down here at this level now. I'd say that's a pretty big level. We also have equal highs. So we're in this sideways consolidation. But think about it. Right now, the XLK relative to the S&P 500 is at an all-time high. It's right up at it. We could pull back temporarily, but we're already there. The S&P 500 is not there. So while we were going down on the S&P, technology stocks were going down even faster. Now we've seen a little bit of a rally off the October low in the S&P, and already the S&P has made up all that relative ground. It's ready to move to a new all-time relative high. We got to see it, but it's there. It's right there. That's not likely to happen right before you're going into a major decline in stocks, in my opinion. And down here at the bottom is the correlation, which pretty much tells you exactly what I'm saying. The XLK relative to the S&P, when you look at the correlation of that relative strength line to the line of just the S&P 500, it tells you it's very, very strongly positively correlated, which means that we need to pay attention to this line going up, because when this line goes up, so too does the S&P 500. And right now we're seeing a divergence. Something's got to give. And I think this is what's going to give. I think you're going to see the S&P breaking out. So let's take a look quickly at the relative strength. And all I wanted to do here was just show you that if we look back over the last 6 months, this goes back before the market bottom. So this goes back into September of 2022. Technology is the best performing sector since just before the market bottom. Industrials are second. Communication services are third. Materials, energy, fourth and fifth. There are no defensive groups in the top half of relative strength. The money's not rotating into defense anymore. And if we shorten this to 3 months, which is basically this year so far, going into the latter part of December, there are only 3 groups higher on a relative basis. The 3 biggest, most aggressive groups: communication services, technology, consumer discretionary. 2023 is a lot different than 2022. 2022, when we started off the first 3 months, these groups were on the bottom, not the top. When we were actually in the bear market and there was distribution taking place, these 3 groups were being sold. You can say the S&P is going down again all you want. It's not being led to the downside by aggressive groups. Money is rotating. That's why the NASDAQ's outperforming. You've got to recognize this, or you're going to be behind the 8 ball when this rally starts. Just saying. All right, let's move on to earnings. Just wanted to bring up one that had reported last night. KB Homes, let's get a quick update. What are they doing this morning? Well, this morning they're up 4.59%, 38.49. And this has been one of the weaker home construction stocks, home builders, by the way. On a relative basis, this has not been one of the leaders. And they reported earnings and jumped 4.6%. That ought to tell us something. Now, we've got 3 more companies that reported, and I'm going to show you their charts as the 3 you must see. So let's take a look here. Okay. So let's take a look first at Accenture. That's ACN. They reported this morning. They beat 269 versus 249. They failed at the 20-day yesterday. They've got support down here around 245, maybe just below 243 or so. Relative strength, don't even have it up here, but I can tell you has not been good. And this morning with their earnings beat, ACN is up $12, up 5% to 265. All right. Next up, GIS, General Mills. This is a defensive group trying to make this breakout back up to around 81. That's where we've been failing, 81, 81 and a half. So we're right about there. Check that out. Make sure we get through on that. If we get through, then I think this one could have further upside, maybe back up to the 86, 87 area. But I need to see that breakout first. And then the final one I wanted to show you is FDS. This is FactSet Research, which reported this morning, and they beat 380 versus 365, but right now not showing anything. Want to watch 435, 436 to the upside. A breakout above that would be bullish. Meanwhile, you can see these bottoms all coming in at about 392, 393. Anything down below that level would be bearish. Right now, we're just in that 10% or so trading range from about 392 to maybe 436. All right, that is it. I do want to point out for those of you who are interested, saw the chart of the day. We do a free newsletter where I feature a chart 3 times a week, Mondays, Wednesdays, and Fridays. All you have to do is go over to earningsbeats.com, scroll down, put in your name, email address, and we'll get you started in that free newsletter. And you can expect educational articles coming out Mondays, Wednesdays, Fridays at about 8:30 a.m. Eastern, focusing on things like earnings, gaps, relative strength, and so forth. All right, that's it for me. Let's see what the market does here at the end of the week. I think we will eventually reverse back off of it, head higher. But, hey, we're going to all find out together. Have a great day, everybody. Have a great weekend, too. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.